Hello everyone. Welcome to this lecture on ISA 200 overall objectives of the independent auditor and the conduct of an audit in accordance with ISAs. Now this standard is very important because it sets the foundation for all other ISAs. Think of it as the backbone of auditing practice. If we don't understand ISA 200, it becomes really difficult to apply the rest. So in today's session, we will go step by step through the standard and discuss its objectives, definitions, and practical implications. ISA 200 explains the overall responsibilities of the independent auditor when conducting an audit of financial statements. Now, when we say independent auditor, we mean the person or firm conducting the audit who must remain objective and unbiased. The scope here is not just performing audit procedures but also about maintaining ethical requirements, professional skepticism, and judgment. Very importantly, ISA 200 clarifies that the audit is conducted in accordance with ISAs. So, compliance with the standards is not optional, it's mandatory if you want to claim that the audit was done under ISAs. Let's talk about the purpose of an audit. The audit's primary role is to increase the confidence of intended users in the financial statements. So, when auditors issue their opinion, they are basically telling shareholders, lenders, regulators, and other stakeholders, yes, you can rely on these financial statements. They are free from material misstatement, whether due to fraud or error. Notice the phrase material misstatement. Not every tiny mistake matters. The focus is on errors or frauds that are big enough to influence users' decisions. Also, remember the auditor does not guarantee that the company is profitable or even that it will survive. The opinion is limited to whether the financial statements are fairly presented. This brings us to a key concept that is reasonable assurance. Reasonable assurance means a high but not absolute level of assurance. Why not absolute? Because audits have inherent limitations. For example, management may hide fraud, or auditors rely on sampling, and some estimates are based on judgment and uncertainty. So the evidence auditors collect is persuasive but not always conclusive. That's why even with the best audit, there's always a small risk that a material misstatement might not be detected. Now, another important area is the division of responsibilities. Management is responsible for preparing the financial statements in line with the applicable financial reporting framework, and designing and maintaining effective internal controls and providing auditors with access to information and explanations. The auditor, on the other hand, is responsible for forming an opinion. This is critical because sometimes management expects auditors to fix their accounts or financial statements, but ISA 200 makes it clear the auditor does not prepare the financial statements. The auditor only examines them. ISA 200 also gives us a set of important definitions. Let me highlight a few. Audit evidence. It is the information we use to form our opinion. Audit risk. The risk of giving a wrong opinion. Detection risk. It is the chance that our procedures fail to detect a misstatement. Professional skepticism. It is having a questioning mind, being alert for signs of fraud or error. Professional judgment, it is applying our knowledge and experience to make sound decisions. You see, these concepts keep coming up in the later ISAs, so you must be comfortable with them. The standard also emphasizes ethics and independence. Auditors must follow the code of ethics, for example, integrity, objectivity, professional competence, confidentiality, and professional behavior. Independence is especially important. Without independence, our opinion loses credibility. For example, if an auditor owns shares in the company they audit, can they really be independent? Obviously not. Professional skepticism means don't take things at face value. If management says, oh, this transaction is genuine, you don't just nod and accept. You check the evidence, confirm with third parties if necessary, and ask probing questions. Professional judgment, meanwhile, is about making reasonable decisions during the audit. For instance, deciding how much evidence is enough or determining whether an accounting estimate is reasonable. These two, skepticism and judgment, are like the twin pillars of audit quality. ISA 200 also introduces audit risk. Audit risk is a product of risk of material misstatement and detection risk. And risk of material misstatement has two levels: risk at financial statement level, which affects many assertions or areas. We will discuss in upcoming videos about assertions. And The second is risk at assertion level, which affects specific assertions. So we first consider the risk that misstatements exist due to inherent risk and control risk, and then whether our procedures might fail to detect them. That is detection risk. To manage audit risk, we need sufficient appropriate audit evidence. Sufficient refers to the quantity, while appropriateness refers to the quality. Another thing ISA 200 stresses is compliance with the standards themselves. Auditors must understand the entire text of each ISA, not just cherry pick sections, and they must not claim compliance with ISAs unless they have actually followed all relevant requirements. Uh, if a uh, if a specific requirement cannot be followed, auditors need to perform alternatives procedures to achieve the same objective. Now, what happens if an objective cannot be achieved? For example, if auditors cannot obtain enough evidence, they may have to modify their opinion, perhaps issue a qualified opinion or even disclaimer of opinion. If the situation is so severe that no reasonable assurance can be given, auditors may need to withdraw from the engagement if the law allows it. Let me give you a quick example. Suppose you are auditing a company that deals heavily in cash transactions. The risk of fraud is high. You design procedures like surprise cash counts, reconciliation with receipts, and confirmation with customers. If management refuses to give you access to cash records, then what happens? Well, you cannot obtain sufficient audit evidence. Under ISA 200, that means you cannot achieve the audit objective. So you may need to modify your opinion or even withdraw. All right, let's quickly recap. ISA 200 sets the foundation for auditing, and the purpose to enhance users' confidence by expressing an opinion. Auditors provide reasonable assurance, not absolute assurance. Management is responsible for preparing the accounts. Auditors only examine. Key concepts include audit risk, evidence, professional skepticism, and judgment. Ethical independence is crucial. If objectives can't be met, auditors may need to qualify their opinion or withdraw. So that wraps up our session on ISA 200. In the next lecture, we will cover ISA 210, agreeing the terms of audit engagements, which deals with how we formally set up the audit before even starting. Thank you for listening, and I'll see you in the next session.